Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone. Welcome to Accredited Investor Markets Radio. I am your host, Christopher Cahill. So let us look at some relevant recent writings. In the Wall Street Journal recently, the president of the Investment Company Institute, Paul Schott-Stevens, said, and I quote, "As the primary regulator for funds and asset managers, the SEC has the expertise and the authority to strike the right balance between protecting investors and the financial system and preserving the important role of the capital markets." By the way, the Investment Company Institute was created in the 1940s to aid the SEC in regulations under the Investment Company Act of 1940. So this is a person who's going to be a partisan in favor of the SEC. But I was struck by the language anyway. The SEC has the expertise and the authority to strike the right balance. Well, we can hope it strikes the right balance. Does it have the expertise to do so? Well, recent events kind of call that into question. Recent events meaning the financial crisis. We should not be so complacently bloviating about our regulators as Mr. Schott-Stevens is, I mean to suggest. And there's a Bloomberg article from December 10th by Dave Michaels entitled "SEC Lacks Reliable Tools to Monitor Employee Trades," audit says. And in the article, the auditor of the SEC is showing that the SEC's own employees are not complying and that the SEC isn't taking appropriate steps to make them comply with respect to trading securities regulated by the SEC. So as I've mentioned before or urged before on this program, we must always have a weather eye on the regulators to make them do what is right rather than do what is wrong or incompetent. The article from which I drew the quote by Mr. Stevens is entitled "Regulator Zeroes In on Risks at Funds." And it's from the Wall Street Journal, December 12, 2014, by Andrew Ackerman. And the funds in question include private equity funds and hedge funds, and another kind of fund we'll talk about in a minute because it's really interesting. But first, the SEC wishes to extend its regulatory regime to hedge funds. Now, the thing about hedge funds, of course, is that they're restricted to so-called qualified investors, and they're meant to be for big boys, if I may use such a gendered term. And hedge funds themselves do not give you your money back when you demand it, and they demand a lot of money from those who invest in it. So the hedge fund gets to hold a great deal of money from entities and persons who have a great deal of money, and it has a great deal of liberty to do what it will with that money to generate high returns, including, for many hedge funds, investing in illiquid assets like distressed companies or distressed securities. Think of collateralized debt obligations from the financial crisis, which had no market. Hedge funds could snap them up and sell them 5 years later when there is a market. Hedge funds are also known to employ various what are called hedge fund strategies. And here's an opportunity for me to point you to a great resource for understanding hedge fund strategies as a term that's thrown around in the financial press. But if you want to understand them, a good place to begin is The Investor's Guide to Alternative Assets, which is subtitled The Jobs Act, Accredited Investing, and You, and it's by Jonathan Friedland. Section 8 is about hedge funds. Section 8.3 is entitled More About Hedge Fund Strategies. It's a short, great place to start to understand these worlds that the SEC chairman, Mary Jo White, wishes to regulate, and worlds we wish to understand. What Ms. White wants to do, essentially, is subject hedge funds to similar regulations as have been imposed on systemically important financial institutions like the big banks. This includes stress tests for how the hedge fund would, how its portfolio would survive a crisis. And this would include review of policies and review of the use of derivatives by hedge funds. And of course, derivatives are principally useful in hedging risk, and so play a large role in hedge funds. And, of course, the SEC would be requiring a great amount of data collection. None of this comes without cost, and this is what the SEC wishes to do. Now, the article in the Wall Street Journal elides, it sort of moves into talking about something else which is not a hedge fund, which is called the alternative mutual funds. And this is a concept that's kind of unusual and kind of new. You know, mutual funds, many of us invest in them. They're available to retail investors. You don't even have to be an accredited investor to invest in a mutual fund. All they do is usually take long positions, investing in the rise of stocks, so that you have a diversified portfolio that rises with the market. It's a good place to put money that you're counting on using later on, money you need. And mutual funds are heavily regulated by the SEC. So the article talks about private equity and hedge funds and then starts discussing the dangers of alternative mutual funds. There is one connection, though. Alternative mutual funds do use some of the hedge fund strategies that I direct you to the Friedland book to learn more about. Such strategies do include use of derivatives. Such strategies include using leverage to purchase either derivatives or to purchase positions by which you balance out a portfolio for the mutual fund. And they might even involve something called long-short equity, which involves betting on some equity to rise while you're betting on other equity to fall, with the intent to ensure a positive record when the market is rising and to minimize the losses when the market falls. Now, alternative mutual funds are limited in the amount of leverage they can use, limited to slightly over 1% of the net asset value of the entire fund. Hedge funds are not limited at all in that regard at this point. Alternative mutual funds cannot use certain kinds of derivatives. Hedge funds can use any kinds of derivatives. And the key thing is, remember, hedge funds have heavily moneyed investors who put money in for a year as a standard term before they can redeem and get that money back. Well, mutual funds are designed, as you know, to permit you to draw out your money at virtually any time. And there are liquidity regulations on alternative mutual funds. They may use a few hedge fund techniques, but their liquidity at all times must exceed 15% of the fund's assets. So, question, is the SEC going to be striking the right balance by imposing new regulations on alternative mutual funds? Is the SEC going to be striking the right balance by causing hedge funds to do what big banks do now? Well, these are questions. I don't accept the assurances of the president of the Investment Company Institute. Well, let's move along to brighter prospects. Let's move out of the financial markets and go up into the skies. One really interesting thing that I read recently, again in the Wall Street Journal, December 14th, by Christopher Mims, and that's not Chris Mim, the journeyman center who played for the Celtics, Cavaliers, Lakers, and Grizzlies in the 90s and early 2000s. No, this is a journalist, Christopher Mims, and he's writing an article entitled, "The Internet's Future Lies Up in the Skies." So, the question is, there are 3 billion Internet users at this time using Internet of varying speed, but there are 4 billion non-Internet users. They must become Internet users. So how do you get enough coverage and speed so that the Internet is available to the remaining human beings on the Earth? Well, one efficient way to do that is to put 3 satellites up into the geostrategic layer of the Earth's atmosphere, or beyond the Earth's atmosphere, which is about 22 miles up. 3 satellites at that height can cover the entire Earth, and indeed such satellites are used, by the way, to provide Internet service to airplanes nowadays. The problem is that when they're up that high, they're not very fast coming to Earth because the impulses have so far to go to get up to the satellite and back down. Which reminds me, as many things remind me, of a colloquy from The Simpsons. In this colloquy, the tavern keeper, Moe, announces that the deep fryer's here. I got it used from the Navy. You could flash fry a buffalo in 40 seconds. Homer immediately responds, 40 seconds, but I want it now. And indeed, when it comes to the internet, 40 seconds is not one eternity, it's many eternities, as you would know anytime your computer seizes up at the office or at home. So many satellites that are used for terrestrial internet coverage are only 485 miles up instead of 22,000 miles up. And they're much faster. The trouble is they don't cover much of the Earth. You need many, many satellites, and satellites are expensive themselves, and they're expensive to get up there because you need a rocket to deposit the satellite. The article, however, talks about new developments. And the first thing we should wonder is, who benefits from new developments? Who benefits from greater internet coverage of the Earth? And therefore, who is investing in these new changes? Well, the answer suggests itself quickly. And the two biggest players, according to the article, are Facebook and Google. Yes, that's who benefits from greater internet coverage. So they've been investing in solutions, and the solutions they're looking at are drones. Of course, that's the solution to everything, but this involves drones flying up to roughly 485 miles and flying around and delivering the internet technology that satellites have been doing. Okay, that's fine. Still sounds kind of expensive. Alternatively, you can use weather balloons, essentially weather balloons, and that is not very expensive. It may be as small as 1% the expense of satellites. This is, I think, Google's solution, not Facebook's, but Google's, which is to send up 20 balloons or more at a time, have them sit there just above the Earth's weather patterns so they're not being buffeted by the weather, and providing what satellites provide today. And, of course, balloons don't last as long as satellites, so you have to keep taking them out of the atmosphere and putting them back up. Balloons after balloons after balloons, a great belt of balloons circling the Earth. I think the idea has legs, to tell you the truth, inexpensive and easy to do and doable. The other aspect of balloons that I find interesting is that if you had held on to your balloon stocks back when the delivery of people through the air was taken over by airplanes, well, where would you be now with Google using the balloons to provide internet services around the world? I think you'd be sitting pretty. You'd be 140 years old, but you'd be sitting pretty. Well, let's get on to the interview. Our guest is David Drake. David Drake is an early-stage equity expert and founder and chairman of LDJ Capital, a New York City-based family office, and of the Soho Loft Media Group, the voice of capital formation, a global financial media company. Mr. Drake has been involved in technology, media, telecommunications, and impact investments for more than 20 years. He is an international speaker and writer for major publications like the Wall Street Journal, Forbes, Huffington Post, and Thomson Reuters. He is co-author of the books Planet Entrepreneur, Crowdfunding and Other Animals, Investors of Italy, I like that title, and is the author of the upcoming books Crowdfund Economics and The Spice of Crowdfunding. And today we would like to focus our discussion on real estate investments in comparative perspective. Again, welcome, Dave.
No, thank you for having me on board, Chris. And I'll be excited by talking about how crowdfunding in real estate is taking off in the U.S., but also what's happening in Asia, Middle East, and Europe in the space of accredited investors getting involved in this space.
And indeed, these sorts of investments aren't just of interest to people in those parts of the world. It's a global market, isn't it?
No, indeed. And the challenge has been in the industry for the last few years that each country has their own regulation on what is allowed to be done and what's not. And that's really what I focused on the last few years, traveling around the world, a few times actually, and interviewing each government and private equity firms and family offices in each country to see why or why not people are raising money in their country and how they're structuring it.
Wonderful, wonderful. Okay, for context though, because most of our listeners, if they are familiar with real estate investing through crowdfunding or accredited investor solicitation, are familiar or active only in the U.S. So what types of crowdfunding or accredited investor solicitation with respect to real estate, equity, and debt have been available in the U.S., and how has that changed in recent years?
Well, look, today when we say crowdfunding for real estate, we're referring to real estate syndication. And the only difference is a new law that passed September 23rd last fall called Reg D 506C, which accredited investors are familiar with. And this law, for the first time in 80 years since the 33-34 Act, allows us in the U.S. for the first time to generally advertise that we're looking for investors and accredited investors. So today when we say crowdfunding for real estate, we're really doing syndication of the old version, but with the allowance of being able to advertise it. And that's a huge difference because out of 8.6 million accredited investors that we saw last year, 750,000 put in $24.8 billion just as angel investors. That leaves another, 7.9 million accredited investors to qualify in North America that, this new law is allowing people to start chase after. And obviously your magazine clearly is talking to them directly.
And when you refer to our magazine, you're referring to accreditedinvestormarkets.com, which is available on the web with many interesting articles. I just thought I'd mention that since you brought it up. So can we delineate then between investment opportunities that have arisen for accredited investors in the U.S. with respect to real estate equity as opposed to debt investments?
Yes. We invested in a publication called Times Realty News, and we're tracking over 100 crowdfunding for real estate platforms on a global basis. About 20 out of those 100 are actually generating revenue. And out of those 20 out of 100, all of them are in the U.S. currently as the top leaders. 4 out of 5 deals are done based on debt financing. Most of the time, those debt financing solutions are small, between $150,000 to $350,000, and many of them are targeting construction teams or somebody acquiring a property to improve on it, and they'll use the property as a lien to get to hard money lending for maybe 12 months to 18 months to rebuild the property and sell it. That's where we see 4 out of 5 deals happening in the crowdfunding industry. The other 1 out of 5 are equity deals. You put money in as an equity holder into a deal. Unfortunately and fortunately, we're just at the beginning stages of this industry. Maybe maximum 20 platforms out there taking deals online, but they're acting as VCs, which means what for the accredited investor? Well, it means that they'll turn away 999 deals to get that one deal that will fit their criteria and be a success, because they have to be successful for most of their deals. I do say that maybe somebody like Groundbreaker.co as well as Fund America are firms that will take more on their platforms because they're not underwriting or putting money into it. They're helping them help themselves.
Some of these, if I may just break in right there, some of these platforms that act as VCs put skin in the game of their own, and some do not, or do they generally not?
9 out of 10 do not put skin into the game. They'll be an asset manager, and they'll take an acquisition fee and an asset management fee, maybe 2%, and then they might take 20% on the upside should they sell and make a profit. So most of them are not putting their own money in. The few that are putting their own money in, they're not very public. They're not public. They're syndication, family office capital, and they're very quiet. And even though 1 or 2 of them qualify to be in crowdfunding for equity, they've asked me not to be on the list that we're tracking. So today, the majority of people on the platform are not putting their own capital in. However, Crowd Alliance is going into real estate, and they're going to be putting 10% of their own capital into the deal. So there are companies out there, 1 out of 20, who will put their own money in.
Well, going back to debt, when you were describing that 4 out of 5, well, I don't want to put words in your mouth, but when you were describing the kinds of deals a number of debt platforms were contemplating, they were tended to be small. And that made me think that in that event, those kinds of debt platforms or opportunities are really replacing what used to be done by community banks, perhaps? Are they filling a gap?
Well, they're actually just taking hard money lending and reducing the fees by doing it online. Hard money lending, I've seen sometimes, 15, 20, 25% return. By taking this online, there'll be more competitive structure in place for reducing hard money lending. So, one hard money lender that we're working with in Connecticut, he's happy with 11, 12% return because he's doing community good of restoring houses in New Orleans. There's still 140,000 homes in New Orleans from Katrina that are damaged. And I think, the hard money lenders are going to start seeing more and more competition from the online versions doing the same job. And the beautiful thing with online, is the cost of the distribution is so much lower than, paying $10,000 for an ad in a magazine. Cost issue here. So the online community is reducing the cost. And also, we're avoiding, in the old days, I used to get $200-$300 invoices from my lawyers for copying paper. Because of the online community, we don't have those expenses anymore. It's just reducing the overhead to actually convey and do the due diligence.
I'm beginning to think you think we could do with fewer lawyers. I wonder how I feel about that. Being an attorney myself.
No, you still need lawyers, but they're just going to have to do a different kind of work.
Yeah.
Actual work.
Well, interesting work too. What trends do you see happening in the near future in the regard of a real estate, accredited investor kinds of funding for equity and debt?
Well, I'm bullish on the real estate mainly for the following reasons. A, it's a $40 trillion market in the U.S. B, property rights is something the U.S. economy is based on. And because of that, just about every government in the world will have interest in investing in U.S. real estate because the property rights are really strong and transparent. And there's a legal system allowing us recourse that's far more efficient than other countries. And furthermore, on the real estate, we understand a block of walls across the country in a certain market. It's easier to calculate. A startup has so many unknown markers. A startup can walk out the door and all the money's gone. But with real estate, that real asset is irreplaceable. So if something goes wrong, the land and the property is still there. So it's, a product and an asset that we understand. The other section to why I'm bullish on real estate is the following reason. As of 2010, more people are retiring and then coming into the workforce, and that will continue for another 40 years. For pension funds and institutional investors who now are getting hardly any interest whatsoever return on their bonds and treasuries, and they have already allocated the maximum allowed for public equities, they have to compensate for the losses of the great financial crisis. And that's going to be alternative financing, alternative investing. And obviously, to me, real estate is probably the biggest part of that opportunity for them to make 8 to 10% return and compensate for the losses they made of the great financial crisis, but also take care of the increase in people retiring over the next 40 years. So I'm just going to see, by default, forcing real estate to increase in value over the next 20 years because the pension funds don't have a choice. They have to find a replacement, and that's either going to be commodities and real estate. I think both areas. Now,
you envision that, or do you see signs of it already in the behavior of pension funds?
Oh, we see it already, and not only in the pension funds, but we're also seeing in certain real estate markets in the U.S. today are exploding with buildings. Miami and New York has buildings everywhere. I mean, I never thought anybody would ever build west of 10th Avenue, and there's several dozen properties in Manhattan popping up left and right, and they're getting, $1,500 to $2,000, no, $3,000 a square foot, which, 20 years ago, nobody would dare go west of certain avenues. So there's always been a demand for Manhattan, and it's a safe haven. Any crisis we have globally, people want to put their money in a safe haven. It used to be Switzerland, but now it's, with the securities laws being removed, you don't have the same advantage in Switzerland as you did before. So, you got Luxembourg, you got London, and New York. Every time we had a crisis, and I wrote about this for the Russian default in 1998, and New York Real Estate Journal, that the first thing people do is, okay, we put money into Manhattan real estate and use treasuries. That's our safe haven, because that's what we believe in first. So Manhattan real estate has always done well and captured any small losses in most crises that we've seen over the last decades.
Oh, that's very interesting. Well, I'd like to close off the discussion of the U.S. By going back to what you just said and back to something you seem to have said earlier. And that is that through these new modes of capturing investment in real estate, would you say then that it's easier, it grants greater access for foreign investors generally And do you expect it to give greater access to sovereign foreign investors as well?
Well, because of this pressure to invest more in real estate over the next 20, 30 years, the online community, including accredited investors, is going to see more and more transactions by hedge funds, private equity funds, towards pension funds and institutional investors to do those reviews and due diligence of online. And there, like we saw in 1993, if you look at Wikipedia, there were 633 websites. Within 4 years of that, AOL went public. That same revolution is happening in the online community today. Foreign credit investors, but everybody else too. Pension funds are more and more going to be looking at opportunities through data room and review hedge funds' performances online as opposed to in the old days where things had to be FedExed or you have to show up in person. I'm not saying you don't have to show up in person. I'm just saying that a big part of the due diligence is now happening electronically. So we're going to see shakeout over the next 10 years where the middleman will see pressures from the online community taking some of the business, and the Merrill Lynch and the large investment banks are just going to say, well, yes, I know this online optimization that we see right now is going to, eat into our profit in certain areas, but if somebody gets big enough, we'll probably just buy them. That's what we're seeing with the big banks. They're aware of it. It makes them nervous, but they'll just acquire somebody in that space as they see efficiencies coming through. So real estate, I like the efficiency, and when we go to international investors, they normally don't have access to any U.S. deals. Of course, there are not any platforms out there who are really addressing foreign investors into U.S. real estate because there's also some, anti-money laundering and the Patriot Act you have to deal with. It becomes complicated.
A potential opportunity, one might say.
Right. In the online world, there's now reviewing deals online. I mean, every time I get a deal that's real estate, I always ask for, all right, where's the deck, where's the presentation, where's the floor plan? It's all done online now. So the movement of information is much faster, and we haven't even started seeing international clients starting to look at investments in the U.S. when it comes to real estate. That hasn't even started yet. And so that's the next big thing, end of next year.
That's exciting. Well, then flipping the script, there has been this sort of access of investors to equities and debt that's new in the U.S. might not be so new in the EU or elsewhere. Can you describe how these sorts of transactions have been done in recent times elsewhere?
Well, I'd say the first real estate transaction was really a pub in the UK that raised $1.6 million about 2 years ago on Crowdcube. And that was a pub that used its patrons and existing laws in the UK, allowing them to take money and give people stock for opening up a new pub. That's one of the earlier stages in real estate ones we've seen. And historically, 10 years ago, the real estate syndication is the same thing. It was just that we weren't using the internet to facilitate the documentation and due diligence. So the difference for me from syndication to crowdfunding online, the only difference is you're using the computer to facilitate a lot of the transactional cost of doing the due diligence. The only law that's been passed in the world for crowdfunding for equity to date that's functional is in Italy. I mean, we signed the Jobs Act, Jumpstart Our Business Startups Act, April 5th, 2012, Obama, but the crowdfunding portion of that Jobs Act, even now 2.5 years later, has not passed and will not pass till and be functional law until early 2016. Yet again, under that law, you can only raise $1 million. A lot of real estate is way beyond that. But, $1 million equity with debt allows you to buy a property $4 to $5 million worth. For all purposes, anybody listening to this today, what I want you to take away is crowdfunding for equity today is using existing exemption under SEC law, which is 506B or 506C, Reg D, which most credit investors are aware of because they qualify. And they're conducting those transactions online, but still you have to be verified being an investor that qualifies as an accredited investor. So that's taking off, but the deals are not very big yet. But we expect at least 150 of these platforms by first quarter next year, and maybe a few hundred of them by year end next year, where it makes sense because you're finding an investor on the West Coast for East Coast deals or vice versa. I broke the news for Forbes in March 2013 with top 10, and then I wrote top 40 this April. And in essence, what I was showing was that these things were happening everywhere.
Okay, but let's go back to Italy. Italy enacted what kind of law and when?
Italy enacted a law last summer, 2013, for crowdfunding for equity, where you can take as little as 500 euros towards crowdfunding. It took them a year to start doing transactions because the burden was on the broker-dealers having to know their investor, know your investor criteria, and that kept that law delayed for a year. Unfortunately, it does not cover real estate. It has to do with high-tech companies only.
Okay, then let me then just pose this question to you. Since you did write the book, Investors of Italy, if somebody were looking at the Italian economy, which is even among European economies particularly suffering, and think, well, there's an investment opportunity there, an Italian real property on the assumption that Italy will recover one day, maybe I should buy now or invest now. How would one go about doing that, or is that even possible from the U.S.?
We do not have a distribution network allowing that to happen on an individual person's capacity, but we do see opportunities with public stock in Italy based on real estate, like REITs, where we felt that REITs holding real estate in Italy are undervalued compared to the U.S. In addition to that, there's logistics challenges. It's not a transparent market, and there are opportunities in real estate because we understand real estate, but managing it and the tax laws and the different nature of business have just prevented my own organization to invest there. We've been over there at least 4 or 5 times a year looking at opportunities, and we're still evaluating where we would like to enter ourselves. For people listening to this show, if they can find a way to get access to Italian public stock based on REITs, there might be an interesting area for them to look at. But I don't know where to send them today.
Okay, well, then I'd like to close with your thoughts on where, among foreign nations, these opportunities would be more easily pursued than perhaps Italy.
I would tell people to stay to the U.S. The transparency and the depth of crowdfunding and what we allow to do far surpasses what's happening accumulatively across the world in this space. The transparency, the legal recourse, and understanding of real estate in the U.S. makes it a safe haven to invest in. So my recommendation is read up on it. Go to Forbes, look up my articles at Huffington Post, read about what's happening, maybe join one of our conferences. We're having one November 13th in New York City, focused on family offices and real estate as well as oil and gas. And just monitor the industry. You'll learn so much just reading a couple of articles on what's happening.
Well, all right, David Drake. I want to thank you for joining with us today.
No, thanks for having me. And if people come to my website, the Soho Loft, we're giving away a magazine for family offices that took us a year to prepare. So I do welcome people to go and get one at the Soho Loft.
Oh, and the Soho Loft, that is a conferencing, networking, information providing, communications company, isn't it?
Correct. We're educating people who to go to find the money, how to pitch them, and what's legally allowed to do to get the money.
Okay, a great source then of information by various means.
Indeed.
All right. You're welcome. You're welcome. And thank you for listening. Stephanie Strait produced Accredited Investor Markets Radio. I am the host, Christopher Cahill. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.